Today, we are all in on silver. And, not just the question of if it will rally, because there's this powerful belief building in the markets about a massive silver bull run in 2026.
Right.
We're diving deeper into what might be the most critical question. How do you own it? How do you structure that ownership to get the most safety and, frankly, the most profit?
Exactly. We were looking at some really insightful analysis that shows the smart money, we're talking hedge funds,
Yeah.
family offices, they're moving aggressively into one very specific vehicle.
And that's the Sprott Physical Silver Trust, PSLV.
That's the one.
So that's our whole mission for this deep dive. We're going to break down why the pros seem to be prioritizing ownership of the actual metal, not just a paper promise, and why they prefer this trust. We'll unpack the structural side, a huge tax difference that you just can't ignore, and then some recent market signals that, well, they seem to be pointing to the start of the next leg up.
And our goal for you, the listener, is really to get past that general I'm bullish on silver narrative and actually understand the mechanics of how to optimize it. We're zeroing in on those specific structural and regulatory details that let these big players protect their assets. And this is critical. Keep way more of their profit when they decide to sell.
Okay, so let's start with the basics. The fundamental difference in how you own it.
Let's do it.
If you ask the average retail investor how to get exposure to silver, they'll almost always point to the big famous one, right? The iShares Silver Trust, SLV.
Of course. It's massive, it's liquid, it's the default option for so many people. And SLV is, a standard exchange traded fund. It's easy to buy, easy to sell, it tracks the price. But the key distinction, and this is everything, is what you actually own.
What you own.
With a standard ETF like SLV, the silver you think you have a claim on is often, well, it's unallocated.
Unallocated.
Right.
Okay, so what does that actually mean for me as an investor?
It means you hold a claim against a custodian, like a big bank, on a large pool of silver. But that pool, it might be used for other things. It can be leased out, loaned out, used for hedging. You don't own specific bars with serial numbers on them.
So in a real crisis.
In a scenario of extreme market stress or, some kind of institutional failure, that introduces what we call counterparty risk. You are completely relying on a third party to honor your claim on that silver.
And that third party might have other competing claims against that exact same pool of metal.
Precisely. So if your goal is absolute security, the kind that people who are worried about the banking system want, that unallocated structure is a liability. It's a big one.
Okay, and this is where PSLV comes in as the alternative.
This is the whole reason it was structured differently. It's a closed-end trust, and it holds fully allocated silver bars. That is the paramount difference. Every single bar is identified. It's reserved specifically for the trust's shareholders.
And the storage location is also a big deal here, from what I've read. It's not just sitting in any old vault.
No, absolutely not. The physical silver is held at the Royal Canadian Mint. That's a sovereign facility. And what's more, the trust's mandate explicitly forbids leasing or lending out that metal. It just sits there.
So it completely eliminates that counterparty risk we were talking about.
It fundamentally eliminates it. For anyone positioning for some kind of dramatic monetary shift, that security is like step one. It's non-negotiable.
That structural security is clearly a huge differentiator. But the analysis we were looking at called this next point the real secret weapon that the pros use. And it's all about taxes for U.S. investors.
Yeah, this part is fascinating. Because even if two investors make the exact same return on silver, like percentage-wise, their choice of vehicle can determine if they keep, say, 72 cents on the dollar or 85 cents. It's that big a deal.
Okay, let's break that down. Why is a standard silver ETF taxed so badly in the U.S.?
So physical metal ETFs, including SLV, are often classified by the IRS as collectible.
Collectibles.
Yep, the same classification as, a piece of fine art or a rare coin collection.
How does a commodity that's essential for solar panels and EVs get taxed like an antique painting? That seems completely wrong.
It's a quirk in the regulatory code, but the impact is, it's brutal. Collectibles are subject to a maximum long-term capital gains tax rate of up to 28%.
28%.
So if you're a high net worth investor and you realize these massive gains everyone's predicting, giving up almost a third of your profit just because of how your holding is classified it's incredibly inefficient.
And this is where PSLV's structure, being based in Canada, changes the game.
That's it. Because it's domiciled in Canada, the IRS treats it differently, specifically as a PFIC, a passive foreign investment company.
Great. PFIC sounds complicated.
It does, but it's actually the key that unlocks the savings. All the investor have to do is file what's called a QEF election, a qualified electing fund election, with their annual taxes. It's a simple piece of paperwork.
And once that's filed, what's the benefit?
The benefit is huge. The gains can then be treated as standard long-term capital gains. So you completely bypass that punitive 28% collectible rate.
And you pay the standard rates instead, which are
typically between 15 and 20%.
That's a staggering difference. Let's just put some numbers on that. You buy silver at $25, it hits the target of $50. That's a 100% return. On a $100,000 investment, you've made $100,000 in profit.
Right. And at 28%, you're paying $28,000 in tax.
But with the QEF election, in the 20% bracket, you're only paying $20,000. That's an $8,000 difference.
$8,000. Purely based on which button you clicked when you bought your silver exposure. This is the definition of optimizing your returns, and it's why the pros just preached. They won't touch the standard ETF for a long-term strategic holding.
It makes the power of focusing on net returns crystal clear. Okay, so beyond the structure and the taxes, there's an immediate market dynamic happening right now, an arbitrage opportunity.
Yeah, this is really interesting. We're talking about the chance to essentially buy physical silver for less than the spot market price. You can't do that if you walk into a coin shop.
So explain the mechanism here. What's happening with the trust's price?
Well, the data from the last close, January 2nd, 2026, shows that PSLV was trading at a discount to its net asset value, or NAV, of about -3%.
And NAV is just the literal value of all the silver bars it holds divided by the number of shares.
Exactly. It's the intrinsic value.
So the price you pay for the shares on the stock market is actually 3% lower than the value of the silver they represent. You're getting a markdown.
Precisely. You are acquiring physical, allocated, secure silver at a 3% discount to the spot price. It's a rare chance to enter a position with an immediate built-in advantage.
So you're getting the best vehicle for security and taxes, and you're getting a discount on the actual asset.
Right, and that discount won't last forever. That's the potential kicker here.
Kicker? Explain that.
The analysis points out that while PSLV can trade at a discount when things are calm, historically, during periods of silver mania, when demand surges, that discount not only vanishes, it often flips to a premium.
A premium. So people will pay more than the silver is worth just to get access to it through the trust.
They will. So if the price of silver goes up, and that 3% discount turns into, say, a 2% premium, you get this extra 5% profit boost layered right on top of whatever the silver price itself did.
Wow. Okay, so that covers the structure, the taxes, and the entry point. Let's pivot now to the immediate market action. The analysis called the price action from January 2nd a classic bullish setup.
Yeah, you have to look at the story of that one trading day. PSLV ran up fast in the morning, but then a wave of selling came in. It was a clear attempt to push the price down, shake out the weak hands.
So an aggressive move to scare people out of their position.
Absolutely. The price got flushed down, and fast. But the critical part is what happened next. The institutional buying just roared back in. The price refused to stay down there. It snapped back and closed very strong, near the highs for the day.
So on a chart, what does that reversal tell a technician?
Oh, it's hugely significant. That move creates what traders call a long wick or tail on the bottom of that daily candle. And that long wick is basically the market's signature of aggressive demand.
Meaning there are big players just waiting to buy any dip.
That's it. It shows that large, committed players view any drop to that key support level, around $23.80, not as a risk, but as an immediate gift, an opportunity to buy more. The market simply refused to let silver stay down.
So it confirms the conviction. The bulls are actively defending the trend.
Exactly. The technical chart is basically screaming that the immediate pressure is upward and it's being supported by big money.
Which is the perfect lead-in to the fundamental why. Why are all these sophisticated players positioning themselves so aggressively right now? Let's talk about the macro forecast for 2026.
The heart of the whole bullish case is a really simple imbalance: supply versus demand. The analysis we looked at identifies a severe structural deficit. Meaning global mine supply has basically plateaued. It's even declining in some areas. But consumption is, well, it's accelerating like crazy. Mines just aren't producing enough new metal to meet the demands of the modern economy.
And these demands aren't trivial. They're driven by massive global trends.
Inescapable trends. Silver isn't just a monetary metal anymore. It's the critical industrial metal for the global energy transition. The industrial demand is creating this enormous vacuum in the supply chain.
We're talking solar panels and electric vehicles.
Specifically, photovoltaics, solar panels, or PV and EVs. They are consuming just massive amounts.
And how significant is this demand compared to, say, 10 years ago?
It's transformative. Silver is the most conductive metal on the planet, so it's essential for maximizing energy transmission in solar cells and for all the microcircuitry in an EV. And the analysis highlights that these applications, which are driven by global energy mandates, are projected to hit all-time record consumption highs in 2026.
Historically, silver has always been seen as gold's little brother. It just kind of tracks gold's movements. But if industrial demand is spiking this hard, could we be seeing a decoupling?
That is the critical part of the 2026 forecast. The argument is that This industrial consumption is becoming so vast and so inelastic. I mean, car makers and panel makers have to have the silver, regardless of price, that it will drive the price higher on its own merit.
So silver could run even if gold just sits there.
It could absolutely decouple from gold's price action, which justifies this super bullish thesis.
Okay, so the fundamentals scream shortage, the technicals are screaming buy the dip, and the investment vehicle is optimized. So what are the actual price targets from the analysis?
The short-term target is a swift move to the $30 level. But the really eye-popping numbers are in the blue sky scenario.
Which would be?
Targets of $50 and up. And that extreme target is based on the structural shortage getting so tight that it actually triggers a full-blown market squeeze, where industrial users find that supply is just physically unavailable.
And that potential squeeze is exactly why people are positioning now, making sure they own the actual allocated metal. This whole thing feels like a clear blueprint for how to play this breakout.
To just sort of summarize this deep dive, the professionals are avoiding the counterparty risk of unallocated paper by choosing PSLV. They're boosting their net returns by using the PFIC-QEF election to get that lower tax rate. And right now they're capitalizing on the current discount to NAV as a fantastic entry point.
So the verdict seems to be that PSLV is the optimal structure. The chart says up and the fundamentals say squeeze.
I think that's a perfect summary. And if we could leave our listeners with one final thought, think about that macro challenge. We're banking our entire global green energy transition on this structurally scarce commodity.
For every EV, every solar farm.
Right. So if that industrial demand keeps accelerating past what the mines can produce, and at the same time, strategic investors are hoarding the available supply and refusing to sell, what does a real prolonged physical shortage actually look like? How quickly could that drive the price past that initial $50 target, maybe even much higher? That's something really worth contemplating.